Hello, welcome back to International Finance. So we're going to continue right along with our discussion of foreign exchange and derivatives. So let's jump right in. Our last lectures have looked at the balance of payments in Brexit. We established the international monetary system, and we also made a shift towards corporate finance. We explored corporate governance and specifically addressed the agency problem, and then looked at how all the different solutions to address the agency problem have their pros and have their cons. In our last lecture, we shifted to foreign exchange and derivatives. Specifically, we identified arbitrage strategies. We said this involved 3 steps. We solved for our cross rates. Those were the rates, the exchange rates when we're not moving through the dollar, but the exchange rates that are implied across different currencies. We use those cross rates to identify mispricing. So if someone's offering an exchange rate that's not consistent with the prices that are available in the market, and then we created an investment strategy to take advantage of the mispricing. We also introduced derivatives. We said these are securities that derive their value based on another security's price. So we talked about the spot market where we have prices that happen and trade for right now at time t, and we compared that to forwards and futures and options, which are derivatives markets, where we're looking at prices for time t plus 1, sometime in the future. And we also made quite a bit of work to understand futures as standardized contracts listed on public exchanges and marked to market daily. So we understand that the future is different than the forward. The forward is a contract between 2 parties, highly specialized, over the counter. So I don't really know what the prices are unless I'm a member of that contract, unless I'm a party of that deal. What am I showing you? I'm showing you the S&P 500. Why am I showing you the S&P 500? The S&P 500 is a major index, and this index has prices that occur right now today. So I drew a circle around the trading price, and the big takeaway is that we can observe that there's a price right now for the S&P. We can also look at the futures market. So this is the E-mini on the S&P 500. The E-mini is one of the most, probably the most globally traded security that we have. E-mini contracts are essentially a continuously traded market. So what is this? The E-mini is a futures contract on the S&P 500. Notice that we have futures contracts for March, June, September, and December. So every 3 months, we have a futures contract on the S&P 500. What I hope you draw your attention to is that we also have different price levels that we're expecting the S&P 500 to hit as we look across these different maturity structures. So we would think of, in our parlance, as the S&P 500 as the underlying, and then we would say that the future contract would be the E-mini. So the other thing that I want to point your attention to is that we have the word CME. CME is in reference to the Chicago Mercantile Exchange. So this is a futures contract. It's publicly listed. We can all see the price and we can all get a good sense of what the value is. So in this lecture, we're really going to delve deeper into financial options. We're going to look at one specific type of derivative that's very unique. Financial options are going to provide the right to buy or sell an asset at a pre-specified price, but not the obligation. We have the right, but not the obligation. That option in and of itself is going to be so valuable. And we're going to look at options primarily on currencies, but there are options on everything. There are options on currency futures. So this is from the CME group. The clip here is, again, a Euro FX future and options market. There are options on indices. There are options on stocks. There's options on ETFs. So there's options on everything. Our next lecture will use option theory to understand how firms make investment decisions. And that application is called real options. And specifically, we'll look at foreign direct investment. But let's jump into options. So the way that we'll think about this is primarily through the impact on free cash flows through the numerator. We have the firm. There are going to be some prices, some exchange rates that for us are very favorable. So at those exchange rates, we have good revenues, our costs are reasonable. There are going to be other exchange rates that for us are very unfavorable. So we could see a decline in revenue, we could see a reduction in demand, we could see an increase in costs, lots of different things. But the way we'll think about it is we're going to try to figure out what are some option strategies that we should adopt given our expectations about price movements. And the reason why this will be important when we think about firm value is because we'll see that there are plenty of different option strategies that we can take as a financial manager, as an investor, as a speculator, conditional on our price expectations. So what are options? European call options gives you the right, but not the obligation to buy an asset at a pre-specified price, the strike price, at the expiration date. If you have the right to buy before the expiration date or any time before the expiration date, we would call that an American option. The person who writes the call option sells it to you. So they're not providing you this option out of the kindness of their heart and because you two are friends. No, options are valuable. I write the call option, I sell you this option. And what do I have? As the person who writes the call option, I'm obligated to sell the asset to you at this pre-specified price if you exercise your right. When you exercise your call option, that means that you're using the right to buy that asset at the pre-specified strike price. Why would you ever want to use a call option? Okay, well, let's think about it. We're agreeing to a pre-specified price. So today, we're agreeing to a price for tomorrow. Why would I do that? Well, part of the intuition is just buy low, sell high. So if I have a call option, you can think of this as a way for me to secure a relatively low price given my expectations. If I think that a commodity is going to go through the roof, I think that the prices are going to be just too high, it's going to be incredibly high. What do I want to do? I want to lock in a low price today. And the way that I'm going to do that is with the strike price. That's different from a put option. So a European put option gives you the right, but not the obligation to sell an asset at a pre-specified price, again at the strike price. Just like with the call option, if I can use the put option before the expiration, before the option matures, then I have an American option. The person who writes the put option, who sells you the option, agrees to buy the asset at the pre-specified price if you exercise your right. For most of this lecture, we're going to consider European call and put options because they're much easier to price. And intuitively, the things that we'll think of as applying to the American option, the options where we can use them whenever, are also going to apply to our European options. The biggest difference is that the option premium, the price that we would pay for the option, would obviously be higher for an American option, because if I can use the option whenever, if I don't have to wait, then that's going to be more valuable to me as the person who's engaging in the contract. So why would you use a put option? Well, again, the intuition is I always want to sell high. So I want to use the call option to buy low. If I expect the price is going to go up, I want to lock in a low price given my expectation. I want to use the put option to sell high. If I think the price is going to fall, I want to lock in a high price to sell. So let's continue. Within our options, we have different notation. So some of this nomenclature, some of this notation you've probably heard in popular press, media. Sometimes if you're watching a movie or a TV show that has finance people, you'll hear all these terms. So let's make sure we understand these terms. We have our strike price K. Our strike price is the price that we agree to buy or sell the asset at. We have our expiration time T, so it's letting us know when our option expires. We have the current time, so this is today, and then we have our spot price at expiration, S capital T. The price of the call option is C, and the price is going to be a function of many things: the current spot price, the strike price, the time until expiration, the volatility of the underlying asset. Many things will affect the price of our call, and the same applies to the price of our put, P. Here's how we calculate our payoffs. So with the call option, I have the max of S at time T, capital T, so the spot at maturity minus the strike price, or 0. For the put option, I have the exact opposite, K minus ST, or 0. And let's understand ST minus K. So we've been saying that we really want to buy low. Let's put some numbers to this. Suppose you expect that the exchange rate between the dollar and pound, so you think that pounds are going to appreciate even further. So if right now it costs if right now $1 cost you 0.5 pounds, you suspect that the pound is going to grow even stronger. So $1 would cost you, actually, let's not do that example because it's a little bit weird. the main takeaway is that we want to use the call option to secure a low price. So it's a little bit easier if we kind of think about stock or we think about a commodity price. So we'll stick with that as we explain these payoffs. If you think about a commodity price, suppose you're really worried that the price of oil is going to go through the roof. So you think oil is going to hit $80 or $90 or $100 a barrel. What I want to do is lock in a low price today. So I'm going to agree to a strike price, a K. Let's say I put my K at 80. That means that I am buying the right to purchase oil from you at $80 a barrel. If tomorrow we wake up and the option matures and we learn that oil is trading at $100 a barrel, 100 minus 80 equals 20. 20 is bigger than 0. So I'm only going to use this option when it's profitable to me. And the put option is the exact idea, just in reverse. So suppose we're really worried that the price of copper is expected to fall. So we think that copper is going to fall to $70 for a metric ton. Okay, I think it's going to fall. I really want to lock in a high price. So I agree to a strike price of 70. If the price of copper falls below that 70, then every dollar beneath that strike price is a payoff that I'm going to earn as the person who's using the put option. So I'm really trying to secure a high price to sell. We want to be clear that the payoffs are distinct from the profits. So the payoffs do not consider the actual cost that you have to incur to buy the call or put option. Remember, the option is valuable. So if you're someone who's writing or supplying the call or put option to the market, you're doing that in exchange for the premium. And so here we can see that if we want to think about the profit from a call option, we have to take into account our payoff minus the actual cost. And it's the same thing with the put. If we want to think about the profit from our put option strategy, we have to think about the payoff of our put, the max of K minus ST, or 0, minus how much we have to pay in order to actually get the put in the first place. Okay, again, we always want to note that the seller gets the negative of the buyer's profits. So every dollar that you make is a dollar that I lose. For every dollar earned, there's a dollar that's lost. All right, suppose the euro spot rate is at 160. So that means $1.60 will buy me €1. Today at time T, we observe that euros are trading at a forward premium. So we can see in the market, when we look at the futures market, that actually for 6 months or for a year, the implied price, the price today, is lower than the forward price. So we can see in the forward market that if we have forward for 6 months from now, €1 is going to cost me $1.80. So the market's expecting the euro to appreciate. We don't know when, but we can see that the market is expecting the euro to appreciate. Suppose we agree with the market and we also expect the euro to rise. What should we do? Well, there are a couple things we can do. What if we buy and hold euros? What if we sell dollars forward? Or what if we use options? Let's explore our first idea. So why won't we just buy and hold euros? Well, first, that's a very risky idea. Firms have non-speculative needs for cash holdings. We can't just take all the cash that we have and use it to speculate on how we think currencies are going to evolve or how we think interest rates are going to evolve. As a financial manager, if you're managing the firm, if you're the CFO or you're the treasurer or you're the VP of finance, you're going to have multiple needs for your cash. The graph on the right shows that US firms increased their cash holdings after the financial crisis and during the recent global pandemic. So you'll notice that right after 2008, you see a bump in cash holdings and then you see a steady increase. Then as we enter the pandemic, you see an even larger increase in cash holdings. So this is pretty consistent with what's called the precautionary cash theory. And the idea is that firms hold cash to invest, fund R&D, keep employment going, maintain operations, just in case they face difficulties in raising external capital. So if there are periods when it's kind of hard to go to the capital market, to go sell stock or go issue bonds, if there are periods like during a financial crisis or a global pandemic that you expect that are going to be tough, then you hold on to some cash as a way to kind of fund those operations and meet your demands when you can't access external capital markets. Clearly, this increase in cash holdings would suggest that precautionary demands have increased. So, okay, that's fine. We understand that firms are holding more cash, but there are downsides to having such large cash balances. Holding large cash balances can be risky. So this is a reference to an article from the Wall Street Journal that talks about major corporations holding cash in ways to prepare for the crisis, for different crises. And here is the statement. Cash holdings would also likely limit productive investment as companies would save for a crisis that may take more than a decade to arrive. And what's the intuition? The intuition is that whatever cash I'm sitting on, I'm not using for productive means. So let's be more formal. Some of the risk that we would incur if the only thing we did was buy and hold a lot of euros because we expect the euro to appreciate, one of those risks is going to be agency concerns. So large amounts of excess cash can lead to all types of agency problems like we studied when we looked at corporate governance. Pinkowitz, Stahls, and Williamson, 2006, show that the market value of cash holdings is much lower in more corrupt countries. To explain, the market implied value of cash on the firm's balance sheet should be 1-to-1, meaning if the firm has $1 on its balance sheet, the market, if the firm were to be insolvent or the firm were to have trouble, that dollar is worth $1, so it should be 1-to-1. What they observe is that in more corrupt countries, the market implied value of cash on the balance sheet takes a 30 to 40% cut. So the market is treating $1 on the balance sheet like it's only worth 65 cents. And of course, that's going to be because of agency concerns. If I'm worried that all of that excess cash is going to be wasted or going to be used for negative NPV projects, or that I'm never going to get those cash flows as an investor, I'm going to discount them. I'm going to put a much higher discount factor or a much lower expected value on them. The other risk that we incur if the only thing we do is just hold a bunch of cash because we expect euros to appreciate is inflation. We risk the cash falling in purchasing power because it's not going to be earning any interest. So we really worry about inflation. And then the last point is very similar to the point that was raised in the article from the Wall Street Journal, which is really opportunity cost. We would rather invest the cash in projects that have high NPV or use that cash as collateral to secure low interest loans. We'd rather do something with it than just keep it on the balance sheet doing absolutely nothing because we think euros might appreciate. So we've scratched out our first idea. We expect the euro to appreciate. We said if we buy and hold euros, it's very risky because of agency concerns, inflation risk, differences in our expected opportunity cost, all of it. Well, what could we do? We could sell dollars forward at 180 like we did in our last lecture. And we saw that the payoff from that is going to be K, which in this case would be 180, minus whatever the spot rate happens to be 6 months from now. And we want to stress this just super clear. We're always making decisions with the information that we have available